All right, guys. So today's presentation is going to be about 10 tips for being a limit partner. And as I said before, this is by no means all inclusive, the end all be all, but I thought we could kind of go through this and just raise some discussion points here and there. And here are the 9 or 10 things that we'll kind of go at from a high level. For those of you guys who don't know what we're talking about, we're talking about a syndication here or a private placement, where the people here on the right side are the general partners in the cockpit. So these are the guys who find the deal, they find the financing, they do all the operation, they manage the manager, they bring all the investors, and then these are the general partners or the GPs. And in coach, all the passive investors, the LPs come in, and everybody rides in the airplane, and hopefully the plane gets to where it is safely. A lot of you guys are, pretty experienced in this group, and a lot of you guys are thinking about taking that next step to being, buying some single family homes, maybe doing it on a larger scale. But here's the 2-part test that I did and why I kind of went down the limit partner route. And I asked myself, am I good at being a landlord? Which includes managing tenants, contractor, doing deal analysis, which requires you to go after a lot of deals. And not very many of them make any sense. The constant deal hunting, broker negotiation. And the second part is like, do you enjoy doing it? And for me, I think I've told you guys a lot of times, like, I'm not too quite thrilled about real estate. I mean, I like it. It's nice, but I mainly do it for like meeting cool people like yourselves and the cash flow, right? Cash flow is what gets you freedom. So for me, this 2-part test, I didn't pass that first part. I didn't want to be a landlord or be the operations guy. But if you want to be, if you're saying you're okay to both, then congratulations, you can be an operator and be the front man for all these kinds of issues here. So I have a simple analyzer that you guys can just email me for. I should have it in the share drive, but this is by no means what you should be using to analyze a deal, but it kind of takes into account NOI and existing financials, because you should buy a property off existing financials, not pro formas. And it kind of shows you what's the property worth based on the cap rate. But this is kind of the basis of, if does a deal make sense. And I think if you're a limit partner, you should be able to at least understand what goes on here. So first thing I'll talk about today is, a lot of these deals, they have some kind of assumption on the rent forecast. And it's usually not in an executive summary in a deal, but you probably have to ask for it. And here's the way you ask for it. It's like, well, what did you guys assume for the rent increases year 1, 2, 3, 4, 5? You may want to ask what's the average throughout those 5 years. But when I analyze the deals, I look at it from a 1, 2, 3, 4, 5 year perspective, with anywhere from like 1 to 3% is sort of the normal range. As you can see, the national down here, they're forecasting 2.5%, 2.9% in 2019, and 2.8% in 2020. This is from Yardi Matrix, one of those big data folks out there. But of course, that's the national scale. Here are some examples from other markets. These days, Dallas is kind of have been having a lot of problems, I think. It's sort of like Seattle, where some of the rents are actually going backwards. So I would expect to see anywhere from like 2% to 3% rent increases year 1 through 5. Other places not as hot, like Mississippi, I would do like a 1 to 2%, like a Oklahoma City. Does anybody else kind of want to chime in? I know, Roger, you kind of a little bit about this stuff. What do you normally see, or if anybody wants to chime in? Okay, so the next thing, how to calculate your NOI and pick a cap rate. So here, like, in single family homes, the property value is based on comparables. Whereas commercial properties such as apartments, it's based on this NOI calculation. So you guys, I'll send out the recording later, but if you guys want to, if you've never done the math, it's useful to kind of go through so you can kind of understand how do you come about the value of the property. So the calculation is you take the NOI, which is the income minus expenses there, and then that comes out to your net operating income. And notice that doesn't take into account the mortgage on there, the debt service. So this is just how does the asset perform without leverage. So here's the formula again. You take the NOI divided by the cap rate, and the cap rate changes based on what the class of the property is and which market it's at. So, this is why we invest in commercial real estate, because let's just say you have a 100-unit building, you can bump the rents up by $45. So 100 times $45 is $4,500 a month times 12 months. That's $54,000 a year. So let's just say the market, like the prevailing rate for that class of property is an 8 cap. So you take 54,000 divided by 0.08, and you just bump the value of that property by $675,000 in value. Of course, it takes a year or so to stabilize the books for it to legitimately get that value increase, but that's essentially what's happening here. Another example, and say you do a utility bill back to the tenants. Instead of making $45, you're saving $40, which is essentially the same thing in terms of NOI. So you kind of run through the same calculation, and there's that $600,000 of value that you created. And another one is reserve parking, which is a new source of income. At $100 a space times 20 spaces, you run into that 8 cap calculation, you come up with $300,000 of value. Here's probably the biggest thing that I would check on it when you're looking at a deal from an LP's perspective is, what are they using as their assumption for the reversion cap rate? So the cap rate, the prevailing cap rate is what that building is selling for in the area. What is, like in that last calculation, what are they dividing the NOI by? Are they using 0.08 for 8 cap, or are they using a 0.05 for a 5 cap, for example? So what you want to do is you want to get the prevailing cap rate for that class of property in that market. So for example, usually a class property will be about 3, 4, 5 cap. It'll be a lower cap rate than a class C property, which will maybe in like the 6, 7, 8 cap range. It's higher. So when you're analyzing properties and you're predicting the future, you want to be more conservative. So you want to pick a cap rate, a reversion cap rate, which is another word for exit cap rate, plus 1% on the reversion cap rate, like it says here, to ensure conservative underwriting. So for example, let's just say we have a property that we bought for a 6 cap. In our spreadsheets and all our analysis, we want to sort of use a 7 cap for the reversion cap rate. And of course, there's a lot of different rules of thumb. Some guys say you want to increase it by like 0.1% for every few months of holding it. But since, most of these deals are 5 years long, that's how you kind of come up with this plus 1% rule. And it's a little counterintuitive because you're thinking that you want to increase the cap rate in the future, and that when you increase the cap rate, the amount of money that you get per the sale of the property actually goes down. So it took me the longest time to kind of get the hang of it because it is counterintuitive. But as the cap rate goes up, that's assuming that the market softens, so you get less for your money based on how much the asset is making. Cap rate going up means that people are paying less for the NOI. And here's the formula for that. So if the market gets stronger, that property might trade for a 6 cap or might even go less, which is great for you, but you don't want to assume it that way in your assumptions. So here's the example here. Let's just say today this property is at a 6.25. That's what the comparables are selling for in this market. So in your spreadsheet, you want to use a 7.25 in the future. And let's just say, like here, we're using a 1% increase, and that equals 100% return in 5 years. And that's kind of sort of the gold standard. But let's just say we were to fudge the numbers and use a plus 0.5% reversion cap rate addition. That 100% return in 5 years gets juiced to 129% return in 5 years just by tweaking one number. So this is kind of one of the biggest, I call it cap rate gate, because it's sort of like a dirty secret in terms of, fudging your numbers and getting what people want. But in a way, it's sort of like kicking the can down the road. You don't hit your 129% return in 5 years. 3-4 years go by, people sort of just forget about it. There are multiple deals. You can kind of just blame it on the economy, which I don't know if that's cool or not, but it is what it is. So this is a big thing, and I'll pause for questions here. If anybody has any comments or additional questions, because this is sort of a big thing here.
Elaine?
Yeah, go ahead. Yeah.
Yes, I have a question. So I think if we are evaluating syndication deals, I think it's good to have basically expected returns for different exit cap rates, right?
Right.
So that we can kind of have an expectation of, if everything goes super well, this is what we can expect. But if the cap rate, for example, expands by 1.5%, then we are in this spot, for example.
Right. So sometimes what you'll have is, and this is a pretty simple thing to do once the spreadsheet is built, is to do a little sensitivity analysis on this. If you think of these things as, not KPIs, but leading factors, this is probably the biggest factor that I can think of out there of things to manipulate. So this is sort of how it plays around with the numbers here. So
sure. Do you have any historical data of how the cap rate has been like in the past, let's say 30 years? If you look at like a single market and look at the history of cap rates, what kind of cap rate variations we can expect? I know it depends a lot on economy and things like that, but for example, expecting cap rate to go up by 5% is unreasonable, right?
Yeah, I mean, I think it's too subjective. It depends where you are in the market cycle. Like in my opinion,
sure.
We're in the 8th or 9th inning of an 11-inning ball game right now. We don't know when this is going to end. I mean, that's why I look for deals that it's like plus 1%. Unless it's like a very strong yield deal. And
Sure.
That's what I'm looking for these days. Something that's cash flowing today, because all this right here, this is just a wild ass guess on what the reversion cap rate will be in the future.
Right.
So, I mean, you're all these 4 scenarios here, you're assuming that the market will get a little bit softer, which is good.
Right.
But this is just a rule of thumb, plus 1%. I'm sure if we keep next year, or maybe the year after, I'm pretty sure you're going to see everybody start using 0.75. I mean, I see it all the time in like those kind of deals that I see a lot. They're already using 0.5% plus on the reversion cap rate. As you can see how much it juices the returns on paper, right?
Sure.
So this is something to definitely be on the lookout for. But sometimes it's tricky because if a deal, a fraction of these syndicated deals, they're actually really, really good deals where you've bought it off market, and let's just say the prevailing cap rate for the market is 6.25, but for some strange reason you bought it from a mom and pop seller and it's operating at a 7% or 8% cap rate, for example. What do you do? I mean, I don't know. It's kind of do you obviously don't do a +1 on the 8 cap because that's not really realistic, but definitely I think you still go a little bit higher than what it is, or if not keep it the same. If that makes sense.
Right.
Just something to be aware of. I mean, the bigger deals, they're not really off market. They're going to sell for what it's really worth.
Mm-hmm.
Elaine?
Yeah, go ahead.
So I guess it's more a theoretical question. So an increase in cap rate means that the market is getting worse, which means it's shifting more from a seller's market to a buyer's market?
Seller's market to even more seller's market in today's example,
Wait, so it's going to be better for a seller if the prevailing cap rate is increased?
Well, it means that people are getting less for their NOI. Put it that way.
Okay. So,
I mean, today, I mean, maybe we can just agree that today is a pretty strong seller's market, right?
yeah. So if the cap rate were to increase, then so you're saying it's gonna get even better for sellers?
If it decreases, it gets better for sellers.
Yeah. So I was saying, like, if the cap rate were to increase, then it would become more of a buyer's market, right? Like, essentially.
Yeah. The market gets softer. See, I still get confused. I always just think of it one way. The cap rate increases, you get less for your hard work.
Yeah. Okay, got it.
Yeah. Anything before we move on? This is probably the biggest one I'm gonna kind of go over today. Okay. So, here's kind of just a follow-up and here, how do you pick a reversion cap rate? As you can see, this is kind of more of a detail to what I just did on the last slide. How does it juice returns? And a lot of the numbers are backwards engineered from this total return and profit table right here. So another thing, typical lending terms that I'm seeing today, 4.5% to 5.5% interest rate. The agency financing, which is Fannie Mae, Freddie Mac, and then the community banks, which is the next level. And then the biggest one are insurance companies that I don't really typically see too much of, but they're out there. Those are like the real big, those are the best rates coming from that. Typically, you're seeing 25 to 30-year amortization. And here's the biggest thing I think as an LP to look at, like what is the term length? So you're seeing on these agency loans that they're going up to 12 years. And this is, I think of it as a ladder. Like if you buy today and the market kind of craps out on you, that 12-year ladder is supposedly going to bridge you to the next side of the trough of the economy. So you don't want to be stuck with a 5-year ladder because that will probably stick you, I mean, it doesn't take too long to go into the red as the economy. It usually, goes down quicker than it comes up. But still, like a 5-year ladder may put you on the bottom or definitely lower than where you're at today. So 12 years is pretty awesome. I think anything higher than 8, I think 8's kind of the tipping point that you want to be higher than. But this is another reason why you don't want to be a mom and pop investor, getting a 4-plex to a 60 unit, because now you're not getting Fannie Mae, Freddie Mac non-recourse debt. Your amortization may be the same, but I haven't seen anybody get anything longer than a 5-year term. And people just don't know what they don't know, and they don't realize how much they're they're really putting themselves into danger by getting that short term. Questions and comments before I move on to this next one? Oh, and sometimes you'll see extra components onto here, such as the financing the rehab money in, and then 1 to 3 years of interest only, maybe in 4 years of interest only on the loan. If you guys want to take a screenshot of this table, would be kind of a good thing to look at to kind of see, the trend of, this is where the biggest rates are, and that's where the banks are seeing the most issues at. And again, like, the big lenders, they want to see deals where it's 90% occupied or stabilized performing asset, minimum of $1 million loan size. So usually at a 50 grand a unit, you're talking 30 units or bigger. To qualify for these things, you need to have experience on your resume. So you need to sign on a loan to get your Fannie card. And the big thing, debt service coverage ratio of at least 1.25. So using the new tax law with cost segregation to get bonus depreciation, properties go up in value, but on paper, they're going down on depreciation. So this question comes up all the time. As a limited partner, how do I get the tax benefits? And it's the same exact thing as owning it by yourself. All the tax benefits flow directly to you based on your share of your percentage of the ownership. But I would say it's a little stronger in these cases because on these bigger deals, you do a thing called a cost segregation that I'll have a future podcast on. Basically, what's done there is they cut up the property into different components, and different components on the building are able to be written off a lot quicker. And especially since these 2018 tax cuts on these new laws, there's a lot of things that you can do bonus depreciation on and write, some of these components off in the first year. So, which is a real cool thing that people are doing these days, and which is why a lot of people are coming into apartments just for the tax benefits. But don't get caught up in all the marketing of this tag word or bonus depreciation, which I use too from time to time, but it's not really like you're getting tax free. You're just kicking the can down the road till the asset is sold, because you're gonna have to pay the taxes again. Hopefully they may have another thing in the future where you can delay the taxes again and do more bonus depreciation again. But you're gonna have to pay depreciation recapture at some point. But the ideal is if you're in a 5-year deal here, a lot of those taxes can be delayed and kicked into the future. And time is money, right? So essentially it's sort of like a tax or interest-free loan from the government.
Hey, Lane.
Yeah, go ahead.
Do you mind going back one slide? Because I actually didn't quite follow the Fannie card and also what the student mean here.
Yeah, so the Fannie card is if you're in a general partnership in the GP, and so this is what a lot of really high net worth guys do, guys who are above $2 to $3 million in assets. They'll go around and sort of do what I do and meet different leads and operators and say, hey, I will lend my balance sheet so you can qualify for the debt. Again, to get Fannie Mae, Freddie Mac debt, or pretty much for every loan, the general partners need to have the net worth and liquidity equal to or greater than the loan. So for example, if we're going after a $3 million building, I can't just do that by myself. My net worth is not $3 million. So I need to get some other buddies to come on the loan and sign on the loan with me. And so what happens sometimes, and this is kind of why network is so important when you get to this level, is how do you get your Fannie Mae card if you don't have it? Well, somebody sort of just brings you in, because it's a nice gesture. So like, for example, say me and this other guy, we're going to sign on this loan in the general partnership. And the guys who sign on the loan are called key principals, or some other people call them personal guarantees. PGs is another word for this. So let's just say, David, you don't have your Fannie card. You've never been in one of these deals as a personal guarantor or a KP. Maybe we may be nice enough to like bring you in, and that way you can get the experience to be able to do this in the future.
I see. Okay. So they'll check experience in addition to your net worth, right?
Right. So it's two things. You can be a $10 million net worth guy, but not have your Fannie card.
I see. And what's the rate there? Like less than 2 million, 2 to 5? Is that the prevailing rate that they loan at?
Yeah, I mean, these are old, right? But you can see how they are relative to each other. And you can see the general trend of the bigger loan you get, the more lower the rate, which is the banks are evaluating it as lower risk, right? And this is why I say, like, that under $1 million loan size is no man's land.
Right, and the lower loan to value ratio, so the lower the risk, right? So
right. So I don't have too many people that fit in this category, but let's just say you were net worth $5 million and all you wanted to do was just go around and finding good people and sign on their debt for them, lending your balance sheet. Yeah, it's maybe a little risky, but you get compensated for that as part of the general partner for being the key principal. Of course, it's always up for negotiation, but some people make a living doing that.
If it's non-recourse, what's the risk here? Like,
good question. There always is a risk. Like, even if it's non-recourse, let's just say okay, the deal goes south, right? It's non-recourse. In theory, all the general partners can walk away, right? But you can bet your butt that Fannie is gonna do some like searching there, right? For some kind of wrongdoing, or even if everybody was acting with good integrity, maybe they can find something, right? And it's my guess that somehow there's going to be some sort of settlement. They're not just going to let you walk away from $2 million of debt without a little bit of a court fight. Maybe it just means that the general partners need to cough up 20 grand or 50 grand or something like that in legal fees, or just as a settlement. But that's my guess. It's kind of like a LLC, right? Like, you have this corporate veil and it's supposed to protect you, but it does until it doesn't. And that's sort of the non-recourse component. Like it's non-recourse, but it works 99% of the time, essentially. I don't know if that's like the percentage, but it's nothing that, I sort of trust it. It's non-recourse, but it's not ironclad, if you get what I'm kind of saying.
Got it. Okay. Yeah, that's clear.
Right. Definitely way better than recourse debt, of course, but.
Yeah. So one last question really quick. What does AMI mean here?
AMI, where is that?
The green rents less than 80% AMI on the left.
I don't know what that term is.
I think it's area medium income.
Oh, okay.
Yeah, that might be like one of those opportunity fund, one of those programs. Because there's the green one is like this green program where you use like energy efficient toilets and redo some of the plumbing, and then they give you a cut on the rates. Which, most 80s, 90s properties, there's something you can do to improve that. So that's what that is.
So the rent's less than 80% AMI means that it's like a lower income area, right?
Right, but you've got to qualify first before you go in and get those rates. There's this thing called like, there's all sorts of these kind of lending programs, like this opportunity fund thing that I've been learning about. Like I don't know if it's the city or the county, they'll identify a certain area as like an opportunity. It's just not a great area. So they'll identify that zone as, hey, if you guys buy a property in here, we'll give you, if you hold on to the property for 10 years, we'll essentially give away all your depreciation, or we'll let you do a free step up in basis. It's very similar to like the student loan forgiveness thing. If you work in the public sector for 10 years, they'll pay all your student loans for you, which if you ask me is not really that great of a deal. And I think it's sort of the same thing with this opportunity fund program. I mean, it's hard to like justify holding on to a property for 10 years, in my opinion.
Elaine, one more question about the financing side. So you said there's a danger in loans that are, say, 5-year. Do you mean like 5-year fixed and then it resets? Is that like, so the danger is that the rates are going to go up and then?
Yeah, the reset when it changes.
Okay.
All right, but I mean, you can make the argument that, I mean, how much can the interest rates really go up, and you should be exiting the property at that point anyway. So maybe you only have to pay it for 2 years, but then it gets complicated at that point. And then, and David, going back to your question on the punching through the non-recourse veil. I just read an article about these guys who are like lying on the, they were, one of the, like, number one here is like, you need to have a property that's 90% occupied or more. So I think what they did is they had like a property that was 80% occupied. So they colluded with the buyer or the seller to like make it look like it was 90% occupied or more. And then Fannie and Freddie started auditing this stuff and then it busted them. So I think they sued the buyers or something like that.
Oh, yeah, that doesn't sound good.
Yeah. But I don't know, kind of creative if you ask me. I mean, if you're almost there, I don't know. But you're getting government debt, right? It's just like how people play this game of getting a non-owner occupied house and then living in there for like 3 months and then renting it, renting it out. I mean, yeah, you can play games, I guess, but
yeah, cool. Yeah, that's good digression.
Yeah, people get creative. So going back to the cost segregation thing, this is what, this is kind of a good image of one way it does it. You separate the personal property, land improvements, real property, but even that real property, you can cut it up into all these different things that this goes over my head. It goes into things like equipment, different components on the building. And it's just a big engineer and accounting exercise that for the most part, this cost segregation costs about $3,000 to $5,000 to do. And if you've got a property bigger than $1 million, it usually makes sense to do. So some of you guys, if you've got some bigger properties that you've been renting out that are over $500,000, $1 million, it may be worth it to do this if you're planning on holding it for a longer time. Of course, if you're only going to hold it for a few more years, it's not worth it because, this is not a tax break. It's just a tax delay, as I call it. So here I got a quote for one of my properties here. And so what I'm highlighting here is what on the left side is what it's going to depreciate over every year 1 through 28, I guess, or 27 and a half years. So it's saying it's going to depreciate 94 grand or so every year. But after you do the cost segregation, now you can depreciate all this off in that first year. Right there. We're trying to go in with some other buddies to get a little better pricing. But for the fee, that was going to be the additional tax savings at, I think, a 50% tax rate or a 40% tax rate. So you definitely gets a lot of savings there. Here's a copy of a K1. It's pretty simple. On the top part, line 1, 2 on the right side there. This number 2 is the losses that we got, and number 1 was, we only owned this one for like a month, so there wasn't any gains, unfortunately. But you get a loss, and for a lot of you guys, the losses are sort of just as valuable, if not more, than the gains. Any more questions on the taxes stuff, or? Okay. So the interesting thing about, like, so if we're just talking apartments, there's all different kinds of different deals out there, and it's very fragmented. No deal is alike. So me personally, I'm trying to get a different selection of like Class B and Class C deals. And then, also I'm trying to do like the mobile home parks, which is sort of like Class D, but I think it's smart to diversify over different asset classes. And, in terms of, not Class A, I don't really think that there's much good value there in terms of cash flow, but Class B and C and D, I think there's a sweet spot in this red circle here, Class B, Class C. And most times the business plan is taking Class C property and kind of bumping it up to Class B. Also, always got to be cognizant that there's different classes in terms of location. You always want to have a better location than the property class, because you can do something about this class of property by doing some rehab, making it look nicer, mowing the lawns, but you can't really do too much about the surrounding area. It's kind of like having in football, you get a quarterback with a good arm, because you can't improve their arm strength, but you can improve their accuracy as time goes on. So I wrote an article. If you guys haven't checked this out, simplepassivecashflow.com/syndications. But a lot of you guys are kind of in this limbo land of like, do I go to being a limited partner, or do I kind of keep continuing on my track to get single family homes? And I think I've kind of broken it down to 2 components. And then I made a graph to sort of describe my ideas on this. So on the left side of this graph, the y-axis, you have how much liquidity do you have to play with. And then on the x-axis, the bottom there, for those of you guys who've been out of school for a long time, that's how much passive income you're making today, or how much money you're able to save at the end of the year. So if you're able to save more than 30 grand a year, and you have more than, say, $200,000 of liquidity currently, I would say you're definitely move on to syndications and leave the world of single family homes behind. Obviously, if say a doctor making 300 grand a year, he should obviously be in syndications. And then on the other side of the spectrum, 25-year-old engineer, barely saving 15 grand a year, has less than 100 grand in the bank account, should probably focus on being a single family home or small multifamily investor, and sort of build up that war chest to get above that line. The blue line is for liquidity and cash flow as a general partner, because you're still more of an operator. And then that orange line is more as a LP side. Any questions here?
Yeah, Lane, I saw this before and I was pretty puzzled. Do you derive these data points from, just any formula that you run behind it, or these are just points that you estimate? Like,
this is the way I came up with this. Is like, I just started to get, like, I talked to a lot of people and they're all in different situations. And then I was like, well, there has to be some way to model this, just with those two situations and kind of finding the people in the middle. And this is what I kind of came up with. So when I 3 years ago, I was in a situation where I was probably cash flowing about $30,000 a year. And I had sold my primary residence to get $200,000 of liquidity. So if you're kind of looking where I was on the chart, that was right on the cusp of where I'm putting as a liquidity as a limited partner before going to syndication. And that made sense, right? Because I was halfway in, halfway out, and ultimately I picked the path that I'm on today. But I felt like I wanted to be a general partner, and to be a general partner, you need to have about 100 grand ready to go, because you got to pay for things like due diligence, and you got to front a lot of the costs before you syndicate and you raise the rest. But as a limited partner, if you don't have that much liquidity, you're in a couple of deals at 50 grand a piece, and then you're done. The learning stops. So that's how I kind of pieced together this line of demarcation here.
I see. So generally, just GP requires lower liquidity, right?
Right, because you're still on the active side making money, because you're getting compensated as a GP. You're an operator. But most people don't become a GP, right? Like at some point, everybody gets off. Nobody stays on the subway to the end of the line. I mean, at some point, I'm just going to like quit and just do something else and just live off my passive income, right? There comes a point for everybody. And for most people who have a pretty good job, you kind of find an easier job and you invest on the side like this, and it's pretty dang good, unless you're super, you need a lot of money. But then that's another podcast, I guess. Any other thoughts and comments on this, or
does the graph suggest that if you have $500,000, $500,000 liquidity, then you can quit working, because then you don't need any. You can just do a LP, right, and sit there.
Well, remember the x-axis on the bottom is positive cash flow after the day job, right, and expenses. So if you stop working, now you're likely to be negative 50 grand. Well, I don't know, you're pretty cheap, my friend. So you might be negative 10, 10 or 15. But I don't know what that would put you in. This is the first quadrant, right? That'd put you in the second quadrant. That's not depicted here. I don't know where that goes.
I see. Okay, no, I was just speculating.
Yeah. So I'm saying I made this because there were some people with just like a lot of money, right? They're like, oh my God, I read Rich Dad, Poor Dad. I have like $1 million of liquidity ready to go. And I'm just barely keeping up with my expenses because we just spend money like it's going out of style. Obviously, they should be going to syndications because they don't have the time, nor does it really make sense for them to pick up these little dinky single family homes. They need more scalability. And I felt like $300,000 to $500,000 was enough money to kind of go into 6 to 10 deals. And then just think about it, 6 to 10 deals at 50 grand a piece, you should be cash flowing about 4 grand a month, once it gets going.
As a GP or LP?
As an LP. But every situation is different. I think it's just a good background, because you're either on one side or the other, or, maybe we can kind of chat. I mean, but then it's also like, do you enjoy doing, being an operator at real estate? If so, maybe you should be a general partner, even though you're will be on this line, because you want a hobby essentially, and it's because you really like it. which you
Yeah.
may like your day job more.
Yeah. Actually, I, I don't know if you're gonna touch on this later on, but like, is there a cash on cash numbers that you're looking for when you go into a syndication as LP? No.
Usually it's right around 8% plus or minus a few percent points. Like I see it as, you know, low 5% on the low end, 11-12% on the high end. But again, these are all speculations, right? Like from a high level, you can't really count on it being there all the time. Yeah, when you get into more deals, it sort of averages out to be about 8. So, you know, personally, what I'm trying to do is I want to be in about 15 deals by the end of next year as I sell off all my single family homes. So, you know, if you just kind of do the math at like, say, just to be conservative, 8% cash flow, you know, that'd be pretty sweet passive cash flow figure, I think. And I'm not too concerned about like when the deal gets cashed out. I'm more concerned about the cash flow today number, because I know we're kind of going into a recession. So I'm just trying to pick up assets that are cash flowing.
Right. Yeah. I think I look at more of the COC number. That's, you know, more near term, right? Because the long term, you know, the cap rate number is just kind of wild guess. Is anybody's
Right.
guess.
It's a wild ass guess. Exactly. But you know, it's funny. Everybody's so different. Some people are like, well, I have a lot of money. You know, I make a lot of money at my day job. I don't care about this cash flow number because it won't change my life. An extra couple grand a month won't change my life. I want that big, you know, I'm in these deals because I want that big kicker at the end, because then that'll be life changing, or, you know, more lifestyle changing. So it goes both ways. Me personally, I'm more conservative. I think I just want cash flow. If we sell the asset in 5 years and everybody doubles their money, then awesome, right? But I'm kind of like, well, it's like sprinkles on top of it, I guess. It's dessert. It'd be nice if it happens, but I'm just trying to get cash flow. And then I'll finish up with some mistakes that I see unsophisticated investors look at. Drives me crazy. Everybody talks about like, oh, what's the GP-LP split on that deal? You know, is it 80-20 or 70-30? Oh, 60-40 is too high, or 50-50 is too high, or they look at like a preferred rate, a return. That is not, that's how the money gets split out, but it's not what you should be looking at as a LP vetting a deal. You should be looking at what are they using for their cap rate, reversions, what are they using for occupancy assumptions, what are they looking for the rent increases per year, as we said earlier in this presentation. The cap rate thing, occupancy, economic vacancy. People don't dig into the don't dig into performance ROI. Look into the deal, how the deal makes money. Who cares if they're making 80% or a 70-30 split? If the deal is not producing money, who cares how much it is? And if it's based on that pro forma ROI, you know, if they're saying you're going to get 80% or 100% return in 5 years, what are the numbers into that, the assumptions to get to that number? And then of course, people don't invest with people you don't know, like, or trust. That's how I lost a lot of money, because that's not fun. But that's all I had. That was some of just high level stuff. Any questions or any other things you guys want to add that you guys kind of key in on when you guys are looking at stuff? All right.
Are you gonna have a link for the recording that we can go?
Yeah, I'll email it out to you guys.
Okay, cool.
And yeah. Okay, going once, going twice, and then we'll start our own little mini mastermind here with who's left.
Yeah, Actually, a question here.
Oh, good.
Like, I mean, when you look at deals, right? Do you also try to distribute, you know, across different classes of properties and regions? You know, like, for example, like a lot of the deals maybe come from the south, right? And then do you have a point where you say, hey, you know, I'm gonna slow down there and then and look elsewhere, right? Even though there are good deals coming out from there.
Yeah, so I look at it from like a four-dimensional thing. So the four dimensions are first, asset classes, right? Like multifamily, mobile home park, self-storage, assisted living, different asset classes. Uh, as you guys have seen, like multifamily is so overheated. Um, Not to say that you can't find a good deal in multifamily, but there's just so many new operators coming on board. I mean, just look how many like gurus there are teaching this stuff. I mean, I can think of almost a dozen guys that you pay 20 grand to go learn from. And there's a lot of guys doing it who go to those programs and putting out deals. And you can't tell who's real because, everybody can put together a PDF these days. So it's just harder as an LP to kind of figure out which are the good deals because there's a lot more noise there. But I tell I don't think any of you guys fall in this category, but I tell like the newer operators, like, well, do something other than multifamily, for heaven's sake. Do something different, like self-storage or mobile home parks as an operator. But the second way you diversify is different asset classes or different classes within the asset classes. So maybe B and C. The B's are a little more yield deals. The C's are a little more value add. I think the last few deals, like the Huntsville stuff, has been more C class stuff. It's been a while since I did a B class. And there's different thoughts of it, right? Like some people think that you want to have, going into a recession, you want to be in a better asset, like a B class, A minus class asset, because, it's just nicer. And when you're going to go into war or bad times, maybe you want to have a nicer asset to attract the better tenants. But I know you can also look at it from the other perspective, like maybe you want to be in a class C asset which has bigger margins, bigger room for error. So I don't know which is the better way of going, but those are like the pros and cons of both of those routes. There are some like funds that like invest in commercial, class A commercial and, nicer property. And essentially you're the paper holder. And the thought is, maybe you want to be holding on to a nicer asset on paper. But the margins aren't as big, as I mentioned. And just to finish up your question, David, the other ways are different partners, different leads, right? You don't want to work with all the same people. And then you also want to have different time domains too. Like some business plans are different. Like some are 5-year pump and dump deals. Some are refinance in year 4 and hold for legacy hold. I think a lot of people, that I talk to, they've been kind of really nitpicking, oh, should I get the more 7-year hold one or this one? And I'm kind of like, well, just don't think too much about it. Just go and focus on the deal more. Don't worry about how the hot dog is packaged in 4-packs, 8-packs, or 24-packs. Worry about what goes into the hot dog, right? Just go into good deals that the assumptions are right.
Right. Yeah. So to summarize, you say there are 4 dimensions, right? One's time, one's people, asset class. Is the last one location? Or?
Yeah, locations in there too. Location can be seen as like classes within the classes, B class or C class. But then, yeah, you're right. There's probably a 5th dimension then in there too, with like, do you want to be all in the South, all in Dallas, all in Atlanta, or mix it around? I'm not a big guy on looking at like just geographic locations. I'm just more of like the deal needs to be undervalued. Like it needs to be a good deal. as opposed to kind of being in the right markets. Of course, you want to be in an emerging market, but I think the deal is what makes the deal. The fact that it's, not a lot of people were onto the deal and you had smaller competition to get it.
Okay. Wait, so I missed the fourth dimension. What are the dimensions? I didn't catch everything.
I think it was the type of property, right? Self-storage or multifamily, or I think that was the other one you mentioned.
Right.
And for me, the thing I'm questioning now is also, the diversification. How much do I leave in retirements or stocks or things like this, right? Which is relative to that liquidity graph. I can have more liquidity if I sell, right?
Yeah, and so that one's a personal problem. And
yeah.
I at first I'm definitely not a fan of the self-directed Roth IRAs. For many reasons, but the QRPs, if you have 401k money, I'm coming around to that idea. The reason I didn't like it originally was because you have to wait till you're like 65 years to get at the money. And I'm like, no, I want my cash. I want to be able to pull out my cash flow today. But I was talking with Damon this past weekend in Dallas about this concept of kind of what you're talking about, Greg. You want to diversify in both, future money, which is like your QRP, self-directed, tax-sheltered accounts, and your regular liquidity, right? So I was maybe being a little bit naive and saying, well, screw it. I'm just going to get a whole bunch of money that I have no restrictions on that I can get at today. So I went down the route of, let me just take everything out and put it into my own bank account and just invest it out of today's liquidity. So I don't have to play any games in the future. Which I still think is like the way you should do it when you first start out. But now I'm seeing like, there's like the protocol that I'm seeing is like build your cash flow today to what you need. So I'm kind of trying to race to $10,000 passive a month. And then once I have that, that's kind of like my set point of what I think is like what I need, my basic necessities. So once I hit that, then that bucket is kind of full and everything flows out of that into doing QRPs or self-directed IRAs for the future money, if that makes sense. So it's different for everybody.
Yeah.
And there's different situations for all sorts of people. Like a lot of people I talk to, they're cash poor, but they have a lot of money in their 401k. If you've changed employers now, whatever you do, don't roll it over again to a future 401k, but consider putting in a QRP. And if you guys want to read more about the QRP stuff with Damon, he's got that free book. If you want to, like, simplepassivecashflow.com/QRP, you can just read the book and kind of get the gist of it. But that essentially allows you to take your 401k that you left the employer and then roll it into a QRP and invest in deals and get all the good tax treatment and sort of have checkbook control of your 401k to do what you need. But if for people who don't have much money out of their retirement accounts, I would suggest you need cash flow to live off today, is my opinion and how I kind of run my life. So I would try and leak out money slowly so that you don't go above that 40%, 50% tax bracket. But, whatever that may be, maybe take out 20, 30 grand out of your 401k every year and leak it out slowly like that, if that makes sense. But Greg, is that kind of what you're thinking too? Is like, you've got some money in your 401k and, how much?
Yeah. I mean, it's multiple things, right? I've got some previous, stock from previous employer, things like this. And, yeah. And how much do I want to have on hand at any one time? But yeah, I know the QRP thing. I watched that webinar, and I've got the book now, but I haven't read it yet. So
yeah.
It's on the to-do list to figure out how I'm gonna do all that. But I mean, so in line with that, I mean, how much, if you're going towards these syndications, how much cash do you recommend having on hand? Enough for 2 deals, or you know?
Well, if you got in a
sure.
QRP, you can use it. You can use your QRP
It doesn't
money,
matter,
right?
Yeah.
But just know that, well, the QRP money, I'm not a tax guy, but my understanding is that now you don't have to worry about the UDFI tax and stuff like that.
Mm-hmm.
That's the nice thing about the QRP. But before I don't want to cut you off, Greg, but I want to try and stop the recording. But was there any other questions on this, like, this LP tips, or any other thoughts before I stop the recording? And then we can kind of talk about more stuff offline.